Imagine waking up one morning and seeing headlines screaming that the safest thing in finance just lit the fuse on a market crash. Not crypto, not some shady startup, not meme stocks, U.S. Treasury bonds, the stuff your banker uncle calls risk-free, the thing pensions buy to be responsible, the asset that's supposed to calm your portfolio down when everything else is on fire. Now here's the part that messes with your brain. Treasuries can absolutely be the trigger. Not because America suddenly defaults tomorrow in some movie-style apocalypse, but because the plumbing underneath the bond market can seize up in a very specific way. And when it does, it forces selling in places you wouldn't expect, at speed you can't control, in a market that's supposed to be the deepest on earth. That's the Treasury Trap. And if you've ever looked at financial news and thought, why does something small suddenly become everyone's problem? You're going to feel very seen by the end of this. Because what I'm about to describe isn't a conspiracy. It's not even rare. It's a chain reaction. It's mechanics. It's incentives. It's the difference between something being safe and something being treated like it's safe at the exact wrong moment. Let's start with the simplest truth most people skip. A bond is not a savings account. It's a price. When you buy a treasury bond, you're not just buying the government pays me back. You're buying a stream of payments at a price that moves every day. So yes, a treasury is safe in the sense that the U.S. government is overwhelmingly likely to pay you. But it is not safe in the sense that the market value can't fall. And that distinction is basically the whole story. Because the moment rates rise, existing bonds become less attractive. If new bonds pay more interest, your older bond paying less has to get cheaper to compete. That's why bond prices fall when interest rates rise. And when rates rise fast, bond prices don't just fall. They drop, sometimes violently. Now, if you're a normal person holding a bond fund in a retirement account, it feels slow. You're not getting margin called. You're not being forced to sell on Tuesday at 2:17 p.m. But big institutions aren't living in that world. They borrow. They hedge. They lever. They post collateral. They promise liquidity to clients. They match assets to liabilities. They play spreadsheets like they're chessboards. And treasuries sit at the center of all of it. Because treasuries aren't just investments, they're collateral. They're the okay, you can trust this chip you slide across the table to get funding. Now, picture the entire financial system as a network of short-term loans, like constantly. Trillions of dollars rolling over day after day, and every one of those loans wants collateral. What collateral do they love most? Treasuries. So treasuries aren't just safe, they're foundational, which means if something goes wrong with treasuries, it doesn't stay contained in the bond corner. It leaks into everything. Here's how the trap starts. It starts with a simple, boring shift. Interest rates go up. Maybe inflation is sticky. Maybe the central bank stays tight. Maybe investors demand more yield because deficits are huge. The why can change. The effect is the same. Bond prices fall. Now, falling prices by themselves aren't a crash trigger. Markets can handle price changes. That's literally what markets do. The trigger appears when falling bond prices collide with leverage and collateral rules. Because in the collateral world, you don't get credit for your bond's face value. You get credit for its market value minus a haircut, and that haircut can increase when markets are stressed. So imagine you borrowed money using treasuries as collateral. Yesterday your bond was worth 100, today it's worth 95, and the lender says, also, we're increasing the haircut, so you only get credit for 90. Now you're short collateral. That means you owe more collateral right now, or you have to reduce your borrowing. And the way you reduce borrowing quickly is by selling assets, including treasuries, which pushes treasury prices down further, which forces more margin calls, which forces more selling. And suddenly, the safe asset is behaving like the most dangerous thing in the room. This is the Treasury Trap in one sentence. The safest collateral can become the most crowded source of forced selling. And forced selling is where crashes come from. Not fear, not bad vibes, not even bad news. Forced selling, when someone wants to hold but can't. Now, let's make it painfully real with an example you've probably already lived through in some form. Think about 2020. Not the virus part, the market plumbing part. When panic hit, you'd expect investors to run into treasuries, right? Flight to safety. And at first, yes, but then something weird happened. Treasuries started acting glitchy. Prices moved in abnormal ways. Liquidity thinned. bid-ask spreads widened, and it wasn't because the US government became less trustworthy overnight. It was because the market structure got overwhelmed. Dealers, the big banks that make markets, have balance sheet constraints. They can't just absorb infinite selling. Regulations, risk limits, internal controls, all of that matters. And when everyone needs cash at the same time, even treasuries become a sell-what-you-can asset because they're liquid, or at least they're supposed to be. So you get this moment where everyone says, I need dollars now. And the easiest way to get dollars is to sell treasuries. That's the dark joke of markets. The best asset to sell in a crisis is often the one you'd normally buy in a crisis. And when too many people try to do that at once, the safest market becomes the pressure valve that breaks. Now, in 2020, the system stabilized because the central bank stepped in with massive purchases and liquidity support. Basically, it became the buyer of last resort and unclogged the pipes. But don't miss the lesson. The Treasury market can seize. And when it seizes, it doesn't just affect bond traders. It affects funding markets, mortgage rates, corporate borrowing costs, equity valuations, everything that depends on the risk-free rate being, functional. Because treasuries aren't just a market, they're a reference point. They're the bass note in the financial song. When the bass note wobbles, the whole melody sounds wrong. Now let's go deeper into the trap part, the part that turns normal stress into a crash trigger. There's a type of trade that seems like free money to a lot of smart people. It's basically buy a treasury, hedge the interest rate risk, and earn a small spread using leverage. This happens through the repo market, futures, and what's often called basis trading. You don't need to memorize the term, just understand the behavior. Lots of funds take big positions in treasuries with borrowed money because the spread is tiny but reliable. Tiny plus leverage equals meaningful returns. It looks safe because it's treasuries. It looks neutral because it's hedged. It looks boring because the profit per trade is small. And then, when volatility hits, it becomes a stampede. Because when you're leveraged, small price moves become existential. A 1% move might be a shrug for a pension fund. For a leveraged strategy, it's a 5-alarm fire. So the exact trade that loads the system with treasury demand in calm times can flip into treasury dumping when things get rough. And remember, dumping treasuries isn't just selling a bond, it's selling collateral. It's withdrawing the scaffolding while people are still standing on it. Now, let's connect that to what you see in real life. You ever notice how stocks can fall on a day when the economic news isn't even that bad and commentators scramble for explanations? Sometimes it's not about earnings or GDP. Sometimes it's because the discount rate jumped. Stocks are priced like this weird math problem. Future cash flows discounted back to today. When treasury yields rise, the discount rate rises and the present value of future cash flows falls. So valuations compress. That's already one link. But it gets nastier when treasuries cause stress in funding markets. If repo rates spike or collateral becomes scarce, firms pay more to finance positions. That reduces risk-taking across the system. Liquidity dries up, spreads widen, credit markets tighten. And when credit tightens, businesses and consumers feel it. Not instantly, but fast enough to matter. Now your safe bonds aren't just hurting bondholders. They're pressuring stocks through valuation, through liquidity, and through credit. And then, because markets are emotional animals, you get the fourth link. Narrative. People start saying, wait, if treasuries are unstable, what is stable? That's when caution turns into panic. And panic is contagious because nobody wants to be the last person holding a bag they thought was safe. This is why the Treasury Trap is so sneaky. It doesn't require a dramatic trigger like default. It requires a mismatch between what people think treasuries are and how they're actually being used. People think safe means doesn't cause trouble. In reality, safe often means everyone uses it for everything. And when everyone uses the same thing as the foundation becomes a single point of failure. Let's talk about one more piece that makes this worse: duration. Duration is basically how sensitive a bond's price is to changes in interest rates. Longer-term bonds have higher duration. They get hit harder when yields rise. If you own a 30-year bond and yields jump, your price can drop a lot. Like, not ouch a lot. More like, why is my supposedly conservative portfolio bleeding a lot? That's why some of the most shocking safe asset losses happen in long-dated government bonds. And institutions love long duration when rates are falling or stable because it gives them yield and matching for long liabilities. But when the rate regime shifts, it's brutal. Now imagine banks, insurance companies, pensions, and bond funds all holding big piles of long-duration treasuries, while also facing clients who can withdraw, or accounting rules that reflect market values, or regulators who care about capital ratios. You can see where this goes. Even if they don't want to sell, they might have to. Now, if you're listening to this and thinking, okay, but isn't the treasury market enormous? How could it not handle selling? That's the exact reasonable question. And you're not wrong. The treasury market is huge, but depth is not the same as size. A pool can be wide and still shallow. Market depth means how much can you buy or sell without moving the price much. And in stressed moments, depth can vanish. Because the people who normally provide liquidity step back. Not because they're evil, because it's rational. When volatility spikes, you widen spreads. When balance sheet is constrained, you can't warehouse risk. When everyone is selling, catching the falling knife is not a hobby, so the market can go from deep and liquid to thin and jumpy faster than headlines can keep up. That's when the trigger happens. Not just a steady decline, a disorderly move, a break in function, a day where the safest market starts acting like a penny stock. And if that sounds exaggerated, remember, markets don't need to break forever to do damage. They just need to break long enough to force liquidations. A few hours can be enough. Now let's zoom out. Why are treasuries so central right now? And why does that make the trap more likely? Because in the modern world, governments issue a lot of debt. Deficits are large. Debt levels are large. Issuance is large. And the more treasuries that exist, the more they get woven into the financial system. They become the default collateral, the default benchmark, the default parking spot, which sounds fine until the system has to digest a surge of supply at higher yields. More supply means the market needs more buyers. If buyers demand higher yields to absorb it, prices fall. And the fall doesn't have to be catastrophic to cause issues. It just has to be fast enough to stress leveraged players and collateral chains. That's the trapdoor. Speed. Slow changes are manageable. Fast changes force action. Now let's do a quick thought experiment. Imagine a giant room full of people holding a safe token that everyone accepts. They borrow using the token. They lend using the token. They promise payments using the token. They're calm because the token is stable. Now imagine the token's value starts wobbling, not collapsing to zero, just wobbling enough that lenders say, we need more of it. Suddenly, everyone needs more tokens at the same time, so they sell other things to get tokens. But then the token price itself falls because people are selling it for cash too. Now nobody knows whether to hoard the token or dump it. That's how you get chaos from something that was supposed to be calming. That's why it's a trap, because the behavior flips. The safe asset becomes the stress asset. Now, if you're still with me, here's the uncomfortable part. The Treasury trap isn't a one-off scenario. It's a recurring vulnerability. It shows up whenever you have three ingredients together. 1, rapid moves in interest rates or volatility. 2, high leverage or crowded positioning in Treasury-related trades. 3, fragile liquidity in the market-making system. And we've seen these ingredients show up again and again over the past couple decades in different forms. Sometimes the trigger is inflation surprises, sometimes it's policy shifts, sometimes it's geopolitical shocks, sometimes it's just too many people in the same trade at once. Now, I'm not telling you this to make you paranoid. Actually, the opposite. If you understand the mechanics, you stop needing scary headlines, because you can look at the market and ask better questions. Like, are yields rising because growth is strong or because investors demand compensation for risk? Are rate moves gradual or are they jumping? Is volatility spiking? Are funding rates stable? Are there signs of strain in repo markets? Are bid-ask spreads widening? You don't have to be a bond trader to see the vibe shift. You can feel it in how markets move. Calm trending versus sharp, chaotic, whiplashy action. And here's one more thing that makes this relevant even if you never buy a treasury in your life. Treasuries set the risk-free rate, which anchors almost everything else. Mortgage rates, car loans, corporate bonds, valuation models, even the way banks price lending. When treasury yields move, the economy's heartbeat changes. So if treasuries become the crash trigger, it's not because they're evil. It's because they're the lever everyone uses to move the world. Now, Let's talk about the most confusing part people stumble over. How can something be safe and still cause a crash? Because safety has different meanings. Credit safety. Will you get paid? Market safety. Will the price be stable? Liquidity safety. Can you sell when you need to? Collateral safety. Will it still be accepted at full value? A treasury is strong on credit safety, but in the wrong conditions, it can be weak on the others, and the market tends to learn that the hard way. Now, to really land this, let me give you a grounded, almost relatable version. Imagine you own a house in a neighborhood where houses usually sell instantly. Everyone says it's the safest asset ever because real estate always has buyers. Then interest rates jump. Suddenly, buyers can't afford the same prices. Now, in theory, your house is still safe. It didn't vanish. It's still a house. But if you're forced to sell quickly because you got transferred for work or your lender changed terms, you might have to accept a much lower price. And if a bunch of people are forced to sell at the same time, the whole neighborhood's prices reset lower. That's the same idea. The asset didn't lose its fundamental existence. The market price moved in a way that created forced behavior. Now apply that to treasuries, but with leverage and collateral chains and institutions that move billions like it's pocket change. That's why it can turn into a crash trigger. Now there's a final twist that makes this story even more intense. Sometimes, in a crisis, the thing that should protect you stops protecting you. People think bonds always hedge stocks. That's often true when inflation is low and central banks can cut rates in a downturn. Stocks fall, yields fall, bonds rally. Perfect. But in an inflationary environment or when policy is constrained, stocks can fall while yields rise. That's when your balanced portfolio suddenly feels unbalanced. And if both stocks and bonds are falling, where does the forced selling go? It goes wherever there's liquidity, often right back to treasuries. So you can end up with this loop. Rates rise, bonds fall, leveraged players sell, liquidity worsens, yields rise more, stocks reprice down, risk assets sell off, and everyone scrambles for cash. And that scramble for cash is what breaks things. Because cash is the one asset with zero duration, zero price volatility, and total optionality. In a panic, people don't want safe long-term promises. They want money they can use right now. And when the whole system tries to turn promises into cash, at the same time, something has to give. Now you might be thinking, okay, so what stops this from spiraling? Usually, one of three things. Markets stabilize on their own if selling exhausts and yields reach levels that attract real buyers. Or institutions step in, sometimes the central bank, sometimes the Treasury Department, sometimes big private players, providing liquidity or changing rules temporarily. Or less pleasantly, something breaks and forces a reset. A fund blows up, a strategy unwinds, a bank tightens credit, and the system de-levers the hard way. Those are the three endings: soft landing, assisted landing, or crash landing. And which one you get depends on timing, policy, and how crowded the trade is when the shock hits. So what should you actually take away from all this? First, risk-free is not the same as price stable. Second, the most important role treasuries play isn't just paying interest, it's being collateral that keeps the money machine running. Third, leverage turns small moves into big problems. And fourth, crashes are usually about forced selling and broken liquidity, not about whether an asset is fundamentally good or bad. Now I want to validate something you might be feeling right now, because it's a totally normal reaction. If this feels unfair, like the rules are rigged or impossible, that's because the system is genuinely complex. You're not missing something obvious. It's not that you should have known. Most people are taught a simplified version of finance that works in calm periods and fails in stress periods. You're basically handed a map of a city and nobody tells you there are underground tunnels that matter more than the roads. This is the tunnel, this is the plumbing, and once you see it, you can't unsee it. Because you start noticing how often markets aren't reacting to news, they're reacting to constraints. Now to close this, let me paint you the crash trigger version in one clean sequence, like dominoes. Step 1, yields rise fast. Step 2, bond prices fall, especially long duration. Step 3, leveraged funds and institutions face margin calls and collateral demands. Step 4, they sell what they can sell, and treasuries are among the most sellable things. Step 5, treasury liquidity thins, spreads widen, yields jump more. Step 6. The rising risk-free rate tightens financial conditions everywhere, reprices stocks, tightens credit, and drains liquidity. Step 7. Broader markets fall, more collateral is needed, and the feedback loop intensifies. And the final step is the part nobody says out loud until it's already happening. The asset everyone treats as the foundation becomes the thing everyone is trying to liquidate. That's the Treasury Trap. So the next time you hear someone casually say, "At least treasuries are safe," you'll know what they mean and what they're missing. Yes, treasuries are safe from default in a normal sense. But in a system built on leverage, collateral, and liquidity promises, safety can become a crowd, and crowds can stampede. And if you made it this far, you're already ahead of most people watching the headlines like they're weather reports. Because now you know where the pressure builds. You know what safe really means in markets. And you know how the quietest instrument in finance can be the loudest trigger when the wrong conditions line up. And that, honestly, is the whole game. Not predicting the headline, but understanding the mechanism before it becomes one.